day learners, welcome to the last study session in 212 study session C's, and in this study session we'll be looking at reserves and provision. In the last study session we looked at accounting for non-profit organization, and we understand that this organization are always established to achieve some basic objective, which could be political, social, educational, or developmental, and they also get their incomes from various sources, and as well they are expected to prepare some relevant books of accounts to show accountability and transparency. In this study session, which is the last one for this course, we'll be looking at reserves and provision. Now, we must understand that business usually make profit. Most business actually they made profit, and they do not always distribute all their profit and surpluses. When business make profit like that, it is expected that sometimes they reinvest some of the profit they realized or distribute the profit as dividend. But in some instances or in some cases, this organization do not always distribute all of their profits or surpluses, and these excess profits are sometimes or usually kept for specific or unforeseen needs. That is, the profits that are not distributed to members are usually kept for a specific reason or for a reason that are yet to be known, which will be usually unforeseen. Then these excess profit as well are usually classified based on their purpose in the statement of financial position. That is, the profits that are set aside for specific or unforeseen needs are usually classified in the statement of financial position, and their classification is usually based on their purpose. Now, at the end of this study session, you should be able to explain the concept of reserves and its various classification, also explain the concept of provisions and the various types of provision, and as well be able to differentiate between reserves and provision. Now let's start. What do we mean by reserves? Reserves are the amount set aside out of profits and other surpluses which are not meant to meet any liability or losses. That is, they are amount that you set aside out of your profit or surpluses you get, and you do not have the intention of using that amount that you have set aside, that is the reserve, to meet any liability or to offset any loss. There are amounts that are also retained in the business to strengthen the financial position of the business. So any amount of money that you set aside to strengthen the financial base of your business or of your organization are also referred to as reserves. And these reserves are often created to rescue the business in difficult times and to meet unforeseen contingencies. There are times a business may not have the opportunity of accessing loan, or it may not have what it takes to access loan in such difficult situation, or when a situation arises that you do not foresee or you do not envisage. The reserve can be something the organization can fall back. Perhaps, let's say there's a fire accident in the organization and some things needs to be quickly replaced. The organization can easily fall back on its reserves to procure or to replace all of these lost or damaged assets. So the essence of the reserve is to strengthen the financial base of the organization and to provide a kind of lifeline for the business in its challenging and difficult times. Now, reserves can be classified into various forms, and specifically three, but mostly in businesses we deal with the first two, which are we have the capital reserve, revenue reserve, and secret reserve. Now, what do we mean by capital reserve? Capital reserve is the reserve that is created out of the profits generated from non-trading activities. It is important you understand this. It is a reserve that is created out of the profits generated from non-trading activities. Business engage in trading activities, which we call their kind of ordinary activities, that is the activities of buying and selling, and they also engage in some activities that may not be buying and selling, which are non-trading. So if business realize profit from a non-trading activity, the profit they realize from non-trading activities and that they now set aside for future use are referred to as capital reserve. That is, those profits do not emanate out of buying and selling. That's the logic. That is, when we say profits generated from non-trading activities, they are profit that you realize outside your buying and selling activities, and we are going to have an understanding of what non-trading activities means in the next slide. So when we talk of capital reserve, it is the reserve that is created out of the profits generated from non-trading activities. It is also retained for the purpose of financing long-term projects of the company or to write off its capital expenses in the future. If the business had the mindset of financing a long-term project, it may use its capital reserve to finance such long-term project. And capital reserves are not available for distribution. It is important to understand this as well, that capital reserves are not available for distribution as dividend, since they are not generated from trading activities. The bottom line of this is that capital reserves are reserves that are set aside or that are created out of profits generated from non-trading activities. Now, what are the non-trading activities or such profits that can be generated from non-trading activities? We have profits from issue of shares. We can issue share at par, at discount, at premium. When you are issuing share at premium, it means you are issuing it at an amount that is above its nominal value. So when, for instance, a share nominal value is 1 naira and the organization issued that share or sells the share to the public at 2 naira, it means the organization is making 1 naira extra profit, which is referred to as the premium. So that premium is a profit that is generated from non-trading activity. So the organization can keep that premium as a capital reserve. Another source of non-trading profit is from profits on revaluation of assets. For instance, an asset cost is valued at 1,000 naira in the books of account, and you discover that the asset has now appreciated. For instance, you purchase a land 2 years ago for 500,000 naira and it is being valued at 500,000 naira in the books of account, but you are now revaluing the land. Now you discover that the land has appreciated in value and the value is now 1 million naira. That's a gain of 500,000 naira, which is a profit you realize from non-trading activities. It is as a result of your asset increasing. So the extra 500,000 naira you realize or that has accrued on that land is also a profit from non-trading activities, and it could be kept as a capital reserve. Then profit from forfeiture of shares, and as well as profit prior to incorporation of company. All these profits are non-trading profit and which can give birth or give rise to capital reserves. Now, the second classification or types of reserve that we have is the revenue reserve. Now, revenue reserve is the reserve that is created out of trading profit. Here you see the difference. The capital reserve is created out of non-trading profit, whereas the revenue reserve is created out of trading profit. Now, the revenue reserves are retained for the purpose of expanding businesses or contingencies in the future. And we can also divide the revenue reserve into two categories. We have what we call the general reserve and the specific reserve. Now, what do we mean by general reserve? These are reserves that are kept for the purpose of meeting unforeseen liability and to strengthen the financial position. That's general. That is, you are keeping them not for a specific reason. You are keeping them for any need that may arise or any unforeseen situation that may warrant or that may require urgent attention. So it is a general reserve. It's not meant for anything in particular or specifically. That is, it's just meant to be kept for any situation that may arise in the future. But the specific reserve are kept to meet specific needs. They are kept to meet specific obligations, for instance, replacement of assets. Now, the third type of reserve, which is not usually encouraged and which outrightly contravenes the provision of accounting standard, is what we call the secret reserve. This is not legal, it is illegal, so to say, and it is not a recommended type of reserve. And if an organization is caught keeping a secret reserve, they may be prosecuted for that. Now, what do we mean by secret reserve? A secret reserve is the amount by which the assets of an organization are understated or its liabilities are overstated. An organization may have an asset worth, for instance, 1.5 million naira, and decided to value that asset at, or to present that asset as 1 million naira. That is, it has reduced the value of that asset intentionally by 500,000 naira, perhaps to show that the business is struggling or is not making profit or is not financially stable or is not solvent. So when an organization intentionally reduce the value of its assets or overstates the value of its liability, it will be maintaining a secret reserve. The reserve will not be obvious, but the organization will know that the asset worth more than it is presented in the books and the liabilities are lower than what it is represented or presented in the statement of financial position. And what are the main reasons why organizations usually keep secret reserve? Is just for manipulative reasons. They are mainly for manipulative reasons. And what are the ways through which these secret reserves can be kept? It could be by accelerating the depreciation of fixed assets. For instance, you have to depreciate an asset perhaps for 3 years, or let's say 5 years. You depreciated it for 3 years. You are keeping the secret reserve, writing off asset entirely or undervaluing the market value of assets. Anything that an organization does to reduce the value of its assets or overstate the value of its liability will amount to a secret reserve, and it is not in consonance with the principle of financial accounting. Now, the second aspect is provision. I've talked about reserves. They are profits that you set aside out of profit to meet specific needs or future obligations. But when we talk of provisions are also amounts that are set aside out of profit to meet a known future obligation whose amount cannot be determined with certainty. For reserves, most times to meet unknown, to meet future, to meet unexpected future obligation. But for provisions, they are set out of profit to meet future obligations that are known, but you cannot determine the amount of those obligations with certainty. Now, provisions are often made in respect of the following. We can make provision for depreciation, provision for doubtful debt, provision for discounts, allowances. Now, for proper understanding, let's look at the difference between reserve and provision. Now, the basis of difference can be seen in 6 perspectives. Number 1 is their nature, the basic nature. Provision is charged against profit, whereas reserve is appropriation of profit. You should understand what we mean by charge against profit is that you have to deduct your provision before you arrive at your final profit. But reserve is not a deduction from profit, it is the distribution of your profit. So provision is a charge against profit, that is, you deduct it before you arrive at your overall profit, whereas your reserve is always extracted out of the profit when you have arrived at the profit. The next difference is in the purpose. Provision is usually created for a known liability or expense which is not certain, whereas reserve is made for strengthening the financial position of the business. It is not usually kept for a known liability or for a known circumstances, but usually kept in the business to meet future needs that may arise and to strengthen the financial base of the organization. Another difference is seen in the effect on taxable profit. Provision will definitely reduce taxable profit. Now, provision is usually charged alongside expenses before you arrive at profit. That was what I was explaining in the number 1 difference, that is a charge against profit. That is, it is usually deducted alongside expenses before you arrive at profit. That is, and by doing that, it will reduce the profit and it will reduce the tax you will be paying. But reserve does not have any effect on taxable profit, because reserve is just the appropriation of the profit that you have already calculated. Another difference is seen in the presentation in the balance sheet. Number 1, provision by way of reduction from the asset. When you are presenting your provision, this is how you present it. Number 1 presentation is that you first of all deduct it from the asset, for instance, your provision for depreciation, by way of deduction from the asset, and in the liabilities side alongside with current liabilities. Whereas for the reserve, it is shown on the liability side after the capital. That is in the balance sheet or in the statement of financial position. Your provision is usually deducted. For instance, when you have provision for depreciation, you have to deduct it from your assets before you have what we call the carrying amount. Whereas reserve is part of your equity, so it's shown on the side of equity and liability in the statement of financial position. Now, element of compulsion is another area of difference. It must be made even if there are no profit. That's for provision. Provision is something that you must cater for even though when you are not having profit. For instance, like I said, you have to deduct it alongside expenses. So it's compulsory that you make provision for those future liabilities that are certain and that are specific or future need. Whereas reserve is not compulsory. You only create reserve when you have profit. If you don't have profit, you can't have reserve, but you can definitely make a provision even when there are no profits. Then the last difference is seen in the use for the payment of dividend. When we talk of provision, it cannot be used for dividend distribution. You cannot distribute your provision, even though you are setting it aside. You can't distribute that money you have set aside to pay dividend, but reserve can be used for dividend. You can still use your reserve, for instance, your revenue reserve, so to say. You can distribute your revenue reserve as dividend. So these are the various aspects where provision differs from reserves. Let's look at the study highlights. Have look at the concept of reserves and its various classification, concept of provision and the various types of provision, and the differences between reserves and provision. Thank you for listening. We have come to the end of study session 6 as well as Act 2 and 2. Thank you. Bye.